Welcome everybody. This is the wrap-up session on the lives for the Pre-Retiree Academy Foundation for Retirement and kind of what's next for each of you all. I hope you found it worthwhile. We are still getting some content put out. We've had some challenges this year compared to the past years, but we are getting through it. Expect to be to have the full estate planning video up today. Hopefully, ideally, fingers crossed on that. So look out for that. This one will be put out hopefully later in the week, if not the first thing next week. It's a little bit slower and delayed on that, and there's a lot of things that were out of our control in terms of that. So thanks for bearing with us and everything as always. Real quick, let me check on, let's see if I can see the poll here, pull it up. Okay. Going back from last week, I'll go on and answer this as we'll spend a little bit less time on that. But how often should you review your estate plan? Looks like we had almost full consensus on this. Every 1 to 3 years, as well as when a life event occurs, or every 8 years, as well as when a life event occurs. 1 to 3 is usually best. 8 is too long. The laws change in there. You can stretch that if you've had it done within the last 5 years. You can probably stretch that to 5 years, but 1 to 3 is good on that as well. As a reminder, all of our content will remain up for the remainder of the year on our page. So you could go on and save that. It'll work again next year, but after December, it'll be taken down, and we will get ready to launch another one next early spring. So, okay, so just a reminder, and this kind of goes to one of the questions we have on there. Where will your retirement income come from? 38% comes from outside sources like pensions and or Social Security. So the answer to that question, should you count on Social Security as part of your replacement income figures? The question is yes. Most of your replacement income definitely comes from savings, like the ones of your 401k vehicles and retirement plans sponsored by your employers. Usually about 50% of that 80% that we shoot for comes from on that. So this really just kind of shows you a chart which is based on the Social Security Administration's latest analysis. It shows that people with an income of about $72,000 or more per year can count on Social Security payments for about 15% of their retirement income in pensions. If you're lucky enough to have a pension, that'll account for around 22%. So really, in terms of figuring that out, it is important to identify all of those sources, like we talked about in that first module. Where it comes from, well, a lot of different places. It's different for everybody. Obviously, just mentioned Social Security. Pensions and retirement plans are obviously very big on that. Income from assets also are, making sure everybody can see that. Okay, let's see here. Sorry, I'm just going to redo my share. Yeah, there we go. Looks to be better. Okay, good. Sorry. Income from assets, that might be if you have maybe access to a rental property, or you've engaged in a rental property and you have an asset that is producing income. Obviously, you should figure out what that you're comfortable of including on that. Earnings, some people continue to have part-time work, especially a lot of people who retire earlier tend to fall more into a part-time scenario, maybe just getting out of the day-to-day grind, but still aren't ready to kind of give up everything. Other income might be income from like dividends on investments, appreciation, of investments they might use as income. We talked a little bit about that too. But in general, most of the income that everybody gets will come from that. I would say one other place on the other income is that if you have a permanent insurance policy, those do have the ability to, you have some income options that you can do on that. But remember, most of that's in the form of a loan. And just make sure you understand your insurance policy before you make those decisions. Um, it really comes down to this. It doesn't matter if you're trying to figure out where you want to be, or you're trying to figure out how much you're going to be spending, or if you're trying to find places to save more or spend less, or pay down debt. Um, it really is important to kind of have that budget in place. Budget is sampling and allocating and accounting for all your inflows or your income and your outflows or your expenses. Creating those allocations. So in other words, where you're going to place money on a regular basis, and following up on a regular basis to see if things went according to plan. Even though your current expenses are likely to change in retirement, creating that budget today can really and does actually put you ahead of the game when it comes to figuring out what that retirement budget will look like. We can't figure out where we're going until we know where we're at. And I'll say it again, it is not the most fun process. I freely grant everybody on the call that, but it is very important to kind of do that. If you're trying to get all of your debt paid off before retirement, having that budget will identify that discretionary income or other places you might be able to save and then transfer that over to retiring debts like mortgages, or cars or whatever it is that your goal is in terms of that. I also would, um, need to point out again that it's very important to plan for unexpected expenses in retirement. So accounting for, especially over time, home improvements, replacement of things that tend to have to be placed over time, like HVAC, or certain of those things. It's important. It's also important to budget for things that you might not have today, maybe over the long term in the future, increase of healthcare costs and those kind of things. Really, the foundation of your retirement budget, it shouldn't be complicated. Go with what your current monthly expenses are. Divide those in, if you want to, into fixed versus variable needs, things that you have to absolutely have, and wants. What your retirement expectation is, the kind of retirement and lifestyle that you want to live. All of those things really come into that. And then obviously, what your expected monthly income is from all of those sources that you have identified on. So extremely important. Again, not the most fun, but it's a worthwhile exercise in order to kind of see where you're at today, or where you want to go, either one. Um, Prioritize that budget. Obviously, today, if you're still working, you need needs take up the bulk of that triangle, that pyramid, so to speak. Once, you can look at it, in terms of things that you want to set aside money for that, and then savings prior to retirement. A lot of people will go 50, 25, 20, or maybe it's 50, 25, 25. But whatever your particular case is, it's definitely important to kind of identify every little thing. And again, this is how you find that extra money to kind of either create more income for yourself in the future or reduce your expenditures moving forward as well. In week 3, we provided you kind of that personal financial statement template or a net worth statement. All that did is a spreadsheet that identified your assets and liabilities. I really encourage you to keep that up as you move along. If you lose or don't like the one that we provided, banks often have a form that you can use as a paper form or works as a spreadsheet as well. Call your banker friend or ask them if you go through the drive-through. They'll send you one. They don't charge anything for that. But a net worth is simply your assets minus your liabilities equals what your net worth is. It's things like and assets. So like how much cash you have in checking and savings, retirement savings accounts, brokerage or investment accounts, real estate, automobiles, collectibles, anything of really tangible value to you, I think is always good to put on there. And then, of course, liabilities, things like, consumer debt, personal loans, if you have them. Hopefully, all of you are student loan free for yourselves anyway. Mortgage loans, auto, those kind of things. I really think it is a good place. This is the summary page on that one that we provided. I think it's a really good place if you are going to budget to track your net worth. If you're 50 or 55 on this call and you got some, are trying to hit some goals, obviously, if you create a budget, you're going to make some sacrifices in terms of meeting whatever your particular goal is. I really think it's a worthwhile endeavor to track your net worth along with that budget because then you get to see the fruits of your sacrifice, whether it be in debt reduction and watching that debt go down because you're attacking that with the extra discretionary income, or whether that be trying to increase your savings in order to hit a savings goal in order to have more income available to you in retirement. So all of those things are extremely important as well. Oh, sorry. Um, uh, so I think it's nice to track that net worth statement with your budget. It makes your efforts more noticeable than just not doing that. You can see your assets increase as you pay down your debt or your savings go up. Whatever your goal is, you get to see that happen on a regular basis by keeping that updated. Um, I would also say, everybody on the call is a center of influence for someone else, whether it be kids or something like that. Encourage those in your life to do those. If they're going to make the sacrifice and budget and do that, to track that net worth with it in order so they can kind of see what's happening. I think I think it's very worthwhile. Um, Remember, there's plenty of factors that we can't control, but can have an impact on your retirement income and withdrawal strategy. Um, Always go back to those 3 questions. How much money do you need? Uh, when do you need that money? Um, and for how long? Um, and of course, as I said before, if we knew the last one, this would be easier. Obviously, longevity. There's no knowing if we're going to be here 5 days or 5 years or 35 years. But we certainly need to plan on us being here longer. A lot of that is, driven by a lot of different factors. Some we have control over, some we don't. The longevity of our parents and grandparents has a little bit to do with that. Obviously, how your health is today, those kind of things. But accounting for it longer than than average life expectancy is a prudent thing. Um, your strategy also should be flexible enough to count for market fluctuations. We can't control those. We've had a lot of that, in recent days. This will not be the last time that occurs. We will have another bear market at some point in time. I'm not saying it's this year. I don't know when those things happen either. But I can assure you that sometimes there are periods of time where the market goes up, and there are periods where the market goes down, and there are periods when the market stays flat. And we can't control any of those type of things. Can't control inflation. The rising costs will influence how much income you'll need in the future. Um, Really, all you can do is cope with inflation by having a proper investment structure and those kind of things, and just knowing how it will impact you 10 years down the road, 20 years down the road, and so on and so forth. And then obviously futures expenses, um, accounting for those in your budget, whether you need them from year to year or not, accounting for them over the long term is always one of those few factors that we can control. Um, so remember, when we're talking about withdrawal strategies, how you plan to get your money out of your savings can be as important as just as important as how you saved it. Um, we talked a little bit about, the difference of 401ks and 403bs versus IRAs. On the screen, it sums it up well. 401ks and 403bs, if you're pulling your distributions directly from that, typically there are fees associated with that. The fees vary, they're all over the place. It depends on the record keeper and it depends on the plan. Those are all different from plan to plan. It also depends on how often you're going to take it, and those are very specific to how the plan is written as well. There are some plans that I've seen you only get one. We have one plan, you only get one distribution, so you pretty much have to roll it out of the plan. We have other plans that allow it monthly and everything in between. So that is very provider and plan specific. When it comes time to making those withdrawals, you have to deal with the custodian, whether it's through distribution paperwork or whatnot, in order to get that money to you or directly to your bank account. On the 401k and 403bs, when you do distributions, there are taxes that will be withheld. That is an industry standard of 20% for federal withholding, regardless of where your income level will be. And then one of the positives as well is they will help you determine, and in some cases, make sure, in many cases, I should say, make sure that you take the appropriate amount out for your required minimum distributions when it comes time for that. IRAs, on the other hand, typically are no fees for withdrawals. You can set those things up to be automatic directly from the custodian. And you can set it up on a monthly, quarterly, or whenever you want to, or a la carte if you needed. And you can choose your withholding both for federal and state taxes as well. You get a little bit more, although it takes more legwork to do it on 401ks. And typically there's a bit more flexibility when it comes time to withdrawals for IRAs. I think options in both, in terms of your investment options, both in 401ks and IRAs, are adequate. IRAs obviously have the whole universe. So if fixed incomes becomes more of a priority for you, you can be more creative than what you can in plans. However, the plan cost in general, because of the funds available in the plan, are determined by the group dollars at hand. You can tend to get slightly better investment expense that way. So, no right or wrong with either of those things, but in general, a little bit more flexibility in IRAs, and a little bit more stuff that comes directly with on the 401k, 403b side. So as part of that review in terms of that, remember the 4% rule. 4% rules when you withdraw 4% of your retirement savings in the first year of retirement, and in subsequent years beyond that, based on the balance. Pros and cons of that is that it's going to change year to year. Typically, with the 4% rule, you can tack on a certain amount if you need to for inflation, and add that to the calculation if you need to. But in general, that changes a bit. You have fixed percentage withdrawals, which is just, to take a set percentage of the portfolio out annually. The dollar distribution will definitely vary based on the underlying value, but the 4% rule does as well, that kind of thing. 4% is one of those tried and true ones I'll go back to, because typically over time, over the long term especially, returns tend to, especially on the equity side, the stock side, tend to be far superior to that from a historical standpoint speaking. So 4% is a good conservative way to look at it. Fixed percentage, again, it varies. You don't know how much you're going to be taking until the year's over, and you kind of figure that out for that year moving forward. Systematic withdrawals is just where you withdraw only income such as dividends or interest that is created by the underlying investments of your portfolio. This is definitely one way to make your money last without any question. And then the bucket strategy, obviously with buckets, you withdraw assets from one or a combination of separate account or separate types of assets that are in your account. So typically divided up at least into three, which would be stocks, bonds, and cash. Or there might be four buckets in it, like stocks, bonds, diversifying strategies in our case, and then cash as well as part of that. So with the bucket strategy, you can withdraw those assets, and you can create a level, I would say, of predictability, runway, if you will, based on those safe assets. You can understand based on how much money you're going to be withdrawing in a given year, and then withdraw those assets out accordingly to what your budget is, and you can make sure that you have an adequate amount of runway built in on that particular bucket in the case in which I'm talking about fixed income. So, whether you're being prudent by completing some advanced planning, or maybe you're just concerned about recent market volatility, a lot of people on this call have been, for sure. Or whether it's just a prelude to eventually a sharper, broader downturn, you're right to start thinking about how to transition your portfolio from to a more conservative portfolio versus more growth or heavily growth driven. Stocks are important. You're always going to maintain a certain exposure in terms of your asset allocation, or should, from a proper diversification standpoint. But an overly aggressive investment strategy can leave you very vulnerable. And often people start second guess the timing of it. So, this is an example between the next two, is an example of what's known as sequence of returns risk. This is three different portfolios. And you can see the returns of portfolio A are all over the place. 22 in year 1, 15 in year 2, 12 in year 3, then it goes negative, -4, -7, and then averages up 7. So they all average 7. The portfolio B averages 7, up the entire time, which would be nice if it worked that way. Portfolio C has the negative years up front. So -7, -4, -12, and -15, and so on and so forth. You can see on that, when you're saving money, the sequence of returns makes no difference. In other words, it doesn't matter when you're saving if it's up one year, down the next year, and so on and so forth. It really does start to matter when you retire. So as soon as you begin retirement and start taking out money, this particular scenario shows with the same returns of someone, we've added a $60,000 inflation adjusted annual withdrawal. So once withdrawals are added to the mix, you can see, in portfolio A, it goes up, goes up, goes up. We're taking out, and it doesn't matter as much. Portfolio C stays very flat as we'd expect it to, but portfolio B, I'm sorry, remains flat as we expect it to. But look what happens when we reverse the negatives in here. It really affects once we start taking money out. So in year one, we had a -7, then -4, then positive 12, 14. But this person, the amount of money that they had, which they all started at $1 million, greatly changes. And so these other two portfolios hold up well into the 90s. This particular portfolio under this. So like having sensitivity to those as we pull it out can be problematic. Taking too much risk in the event of portfolio C can be problematic. So it's very important that we pull some risk off. Most people are, I would say, very intuitive that they know they need to take a little bit less risk. But I don't want you taking, well, I should say, in general, I prefer that you do not take zero risk. Going all bonds is, in terms of volatility and fluctuation, can be as bad as doing 20% in stocks, 80% in bonds. How much each person should take off in terms of risk is different for every single person on this call. And I'm happy to help with that if you have questions with it. But if you are getting close to retirement and you're still in an aggressive growth scenario, then it probably will start making some sense for you to start rotating some of that money sooner than later, to be a little bit more diversified and protect you a little bit more from these type of things. That's why, evaluating your own personal risk is what kind of all that was for. Whatever mix that you elect, it's really important just kind of figure out where you want that asset allocation to be, and what makes sense for you. How long is your savings projected to last at any, given the size of withdrawals that you're planning on taking? How comfortable are you seeing your retirement savings value fluctuate with a little bit of market volatility? What sources of income do you have that will help limit those type of issues, whether it be Social Security, pensions, taxable accounts, large home equity in some cases. But as a practical matter, most people will enter retirement with somewhere between 40% and 60% of their savings in stocks. Again, that's a general rule of thumb. Everybody is very different on what you should do. As part of this, keep on saving all the way into retirement, because Social Security, we've looked at that. It's not enough for most people. Very few, a lot of people make it their number one source of retirement income, but it's not designed that way. We can kind of help you with some strategies to increase that savings, whether you can max out your contributions. You can do $23,500 a year if you're 50 or under, and then you get catch-up contribution of $7,500. So there is plenty of room to catch up. Not saying it'll be easy, but it's very important that we continue saving all the way up until the point that we retire. Obviously, Social Security is a big portion of that. Just learn the best way to maximize your benefit, or really what strategy you want to take. If you're trying to maximize lifetime benefits, the basic principles of the longer you defer your benefits, the larger your monthly payments are going to be. Each year that you wait from 62 to 70, your benefit will increase up by about 8%. This strategy works best for couples with normal to high to life expectancies, that kind of thing. The other one might be claiming early. A very popular one, if you have health concerns, benefits are available as early as 62. But remember, it's at a discount, deep discount, I might add, from your full retirement age. For everybody on this call, that's 67. For couples that are planning on having shorter retirement period, might consider claiming earlier. Generally, one member of the couple would need to live into their late 80s for the increased benefits from that to offset the difference. But there are plenty of tools out there to kind of help you choose that. AARP's got a really good break even calculator that I've used before with clients. But really, when you take these is extremely personal and is different for everybody as well. Let's see. Delaying your benefit. Um, Obviously, this is really for a lot of different people, but if you delay your benefit longer and you pass away, your spouse is eligible to receive your full benefit. And if yours is going to be higher than theirs by a lengthy amount, and there's a big age difference between you two, that might be something that you consider. So especially if one spouse's Social Security is projected to be quite a bit higher than the other spouse. When to take it? Again, these are just averages, assuming a annual salary of 45,000. Here's one that's based on 80. It's really different for everybody. Make sure that you log into the Social Security Administration site and have an idea of what don't have an idea, see what they show your projection is going to be at 67. And then if you're thinking about taking it earlier, you'll be able to see it as you do that as well. Last week we covered estate planning. A lot of reasons to do it, but the biggest is to have a say in what happens to the stuff you've accumulated, and what happens and who gets the assets and how they get them. And if you don't, then the probate process will take care of that for you. The probate court and judge will interpret the law of the state and distribute your assets in accordance to that. Remember that beneficiaries on all your accounts are extremely important. They do supersede wills, so whoever's name is on that particular form is who will end up with the money. So biggest reason is to have it and have control over who gets it, have that say of yourself versus if you don't, you let the probate court and the rules of the state determine that. I can also say if you do it right, if you have a significant amount of assets or not, you can do it in a more efficient way. Who you leave it to might matter. That might set you up to maybe be a trust candidate, depending on some of the assets or what you're trying to accomplish. But that's why it's really important for you to engage an estate attorney on that, one that makes their living off doing estate and elder care. Again, just if you don't have an estate plan, probate court decides, including guardianship of children. I think everybody on this call's probably mostly past that, but people who you might not want to be in charge of that can be put in charge. And assets can end up with people maybe that you wanted to go a different way. So it saves time by having a plan, and certainly can save who you leave it to money in a lot of different ways. Remember that an estate plan does not just include stuff that happens when you pass away. There's that above the ground planning, things that you need to have in place while you're still living, a durable power of attorney, healthcare, power of attorney, and or maybe a living will, end of life care kind of things. And then advanced healthcare directives that goes with that, organ donation. These are all things that are important to have in place while you're living. And then some of you might uh, uh, be suggested to get do some trust planning. Maybe it'll be a revocable trust, a memorandum of trust, a statement of disposition, if your state allows for those kind of things. Some of those things might require you to retitle assets, maybe transfer the name or the deed of ownership of your of an account or maybe real estate into a revocable trust, living trust type thing. And then also set your beneficiaries, guardianships, and life insurance trust are part of that, or if needed. As I said before, beneficiaries supersede wills in pretty much every state. Um, So make sure if you have life insurance, make sure on your 401ks and IRAs, anything that can be inherited, bank accounts, TODs, all of those things as well. Life insurance, I didn't talk much about that on any of these lives, but we did send out a piece on that. If you have an existing policy, is it a term policy, meaning it's for a period of time? That works more like car insurance. If you don't get in a wreck, it doesn't really do you any good. But it's the cheapest way to shore up in the most common type of insurance. Maybe you have a permanent policy. A permanent policy is one that accumulates cash value and builds up over time. Um, if you have a permanent policy, I would contact your company or agent as you're getting closer to retirement and request in-force illustrations on that life insurance policy. You need two. You want one to show you what happens if you keep paying premiums, and one if you quit, how long that will last. That'll give you an idea if you need to continue to pay that in retirement or not. There are other ways to shore it up in terms of life insurance as well. Another permanent policy is like a second to die. Remember, insurance really just serves two primary functions. It helps create an estate to replace your income in the need of your untimely death. So it helps create an estate, maybe through an endowment, basically of money to help replace your income, or it helps pay for an estate if you are exposed to any type of estate tax. It helps shore that up so assets don't have to be sold quickly in a lot of ways in order to pay estate taxes should they need there. Um, uh, I would also say, do you have any debt? If you're going to die with a lot of debt, having life insurance can be very important as well. Um, what should you consider when enrolling in Medicare Part A? Most people don't pay premium for Part A. It comes, automatically. You do need to sign up when you're 65 for Part A. Once you do that, though, once you're in Medicare, you can no longer contribute to an HSA. And if you decide to delay enrolling in Medicare, make sure to stop contributing to your HSA at least 6 months before you plan to enroll in that. When you enroll in premium free Part A, you'll get up to 6 months of retroactive coverage. So if you don't stop the HSA contributions at least 6 months before that, you might have to pay taxes on those or get a penalty. You are not eligible for marketplace premium tax credits or cost sharing reduction CSRs that lower your plan deductible or co-payment when you qualify for Part A. Remember, if you are taking Social Security, you will automatically be enrolled when you turn 65 into Medicare. You will get a package, if not an IEP package in the mail along with your Medicare card about 3 months before you turn 65. You can sign up for that as you need to. Seven retirement deadlines. 50, you're eligible to take advantage of the catch-up contribution. 59 and a half, there are no more early penalty withdrawals. At 62, you can claim Social Security. At 65, you need to sign up for Medicare. Whether you enroll in it right then or not is neither here nor there. 60, 67, depending on how old you are now, but most of the people on the call are 67 is when you reach full retirement age. And then 70 is the maximum benefit that you will accumulate on Social Security. And 72, that's actually 73 now. Sorry, that is a typo. That just got missed. 73 years old for most of the people on the call is when you'll have to start taking required minimum distributions. And that for some of the younger people, that will accelerate to 75 before you're 75. So it just depends on when you're born of when that RMD kicks in. One of the things I wanted to cover is, a lot of people are going to ask, should they work with an advisor? Totally personal question. Benefits with working with an advisor, obviously, I have a little bit of a biasness, but I'm pretty objective about it. It's not necessary. This isn't rocket science. I'm the first one to tell you that. But an objective approach, that's perhaps like one of the single biggest cause of mistakes that can reduce performance or really create problems, is that lack of objectivity. Investment, and the reason is investment decisions are often driven by emotion, especially when it comes times for feelings of worry or panic, and those decisions can cause problems. So I think that objective approach is really good. I think advisors do a nice job of coming up with creative ways of minimizing taxes. This isn't necessarily always about lowering income taxes, even though that should always remain at the forefront, at least to me. But having a yearly look or a plan of taking advantage of gains and losses in an appropriate manner helps keep portfolios not only efficient, but also keeps large gains from being eroded by large capital gain events, and having to pay taxes on those large capital gains. So it's important to have a forward-looking view, regardless if you're using an advisor yourself, work with your CPA. That is a forward-looking exercise. That's not the same as preparing your taxes. It is looking ahead to see what you can do today to limit your tax. It's things like maybe Roth conversions, maybe taking advantage of a lower income rate you're going to have early in retirement. So just make sure that you work with somebody. Our firm has a team of CPAs to assist in terms of that. Also say, like not only a good analogy of working with an advisor would be this. If you are in your retirement years, kind of like I said up front, and your retirement years are a boat, and it's your boat, and you're going to take a trip, and you've got to cross the ocean, but you're not seasoned at it, it makes sense to hire a captain to kind of help you on that journey. If the advisor is the captain, then a financial plan would really be a GPS, so to speak, kind of telling you the path to go, but it would be one that would also be predictive of what it would look like, how you would hold up in bad weather and smooth seas, rough seas. It would know where the shallow water, deep water is. A financial plan basically can tell you how much you can and shouldn't spend, how much risk you can take, and more importantly, how much you shouldn't take, and all unforeseen circumstances like market drops, loss of income streams, big purchases, and long-term care needs. It also needs to be stressed, whether you do your own plan, you work with an advisor or not, and everybody should have one. That it is not a one-time thing. It's something that needs to be reviewed on a regular basis. It needs to be updated as your life needs to be updated. It needs to be used as a risk management tool. And that is honestly where the rubber meets the road of working with an advisor. If you're working with an advisor and you're not getting a comprehensive financial plan, then I think it's that important of doing that. But again, there are plenty of programs, apps, and things out there that you all can use and put together this information on its own. Risk management, your investment approach doesn't have to be complicated, but there's an element that ideally is required in terms of rebalancing or understanding where you may be in economic cycles or perhaps even a market cycle. And no matter what your objective is, risk is a long-term approach. But there are times in the short term that might call for rebalancing because maybe one asset class is a more appealing based on short-term events or short-term anomalies that the market sometimes has. But it's important no matter how you do that to kind of do that with a plan. And then a lot of people will do it, peace of mind of working with someone, developing a relationship with somebody, having someone you can get on the phone and talk to about it. And it's not a one size fits all. Interview a couple of people, see who you work with, ask around, those kind of things. And I've had clients that have done a lot of it on their own. They get to a certain age and they start to worry a bit about their own health or whatever it is and decide to work with an advisor, maybe just for the broader benefit of the entire family and those kind of things. So whether you want to work with one, it's kind of the same thing as the estate planning attorney. See how their firm is structured, how they bill, what their fees are, what you get for those fees. What a regular meeting would look like, how often you meet and talk with them, and those kind of things. And then find one that you feel comfortable in that relationship with, and that you can build with, regardless if it's someone you feel comfortable with at MCF, hopefully, or anywhere else. It's important to kind of interview and have a broad scope of what you're looking for. Again, all the investment advisors I've ever known, and I know a lot of them. We all take meetings, introductory meetings for free. We're used to kind of being interviewed, and I think that's very important that you do so too. This is an example of what the basics of a financial plan. Every financial plan is going to aggregate all the information that they have. So what you have in your cash accounts, brokerage accounts, if you have it, 401ks, the total liquid savings and real estate. It's kind of under this little banner down here. It's hard to see. But you'll also have predictive cash flow modeling. So this is what we call as a cash flow statement. So in other words, you're going to predict how long someone is going to live, what their age is today, what their incomes are, what their expenses are, what their savings is planned when they retire. This person retires, looks like about 66, shows what their income flows will be for that year and their total portfolio and savings. And then how moving forward, based on spending a certain amount of money, how long will that money last? What happens in the event if we stress it, like a portfolio stress test due to market fluctuations, whatever it may be. Make sure that there are a lot of different programs and platforms out there that you can use, or that advisors use. Just make sure that you are getting this as part of a service. Then from there, you can have, any scenario built that you want to, adding income, a purchase, maybe a gift to a charity, a change in living expenses. Maybe you want to retire earlier and see how that goes, or later. and, increasing your savings, whatever that is. Um, Everybody offers something different. This is just a sampling of what we offer with our suite of services. If you're interviewing anybody and you have questions or want to, just feel free to reach out. You're not going to get this crazy. You're not getting a crazy hard sales pitch from me. It's just not my nature. I want you to be comfortable with it, but we can help with everything from charitable planning, reviewing estate documents, stress testing, portfolio analysis. We can give you spending bumpers and rails, what we call them, those kind of things. So it's just important to kind of look at that. So let's really quick before I go down here and get to Q&A and see what other individual questions that you have. What are some of the major pitfalls? These are questions that people have asked me this year, and a couple of these are in years past as well. But what are some of the major pitfalls or mistakes that people make in retirement, which is a good one? I got that one this year. So number one, not having a risk plan or taking appropriate risk. So in other words, you're either taking too much or not even having a plan with what you're doing, going at it blindly, as I say. I've seen people who stay in high growth oriented risk strategies in retirement. And if there's a significant drop in the market, much like we showed earlier in that sequence of returns, it can be the difference of them having to work again. And I can't stress that enough. This also applies to not taking enough risk. I see a lot of people, they just want to take everything off the table. I see a number of participants say, well, I'm just going to do it through CDs. Listen, there's nothing wrong with some of that, but your perception of risk and mine are different. I can find risk in everything. I can find risk in not taking enough risk. It's called inflation, the erosion of the spending power of your dollar. It's like, death by paper cuts. You can still bleed out if you get enough of them. So it can be detrimental over time. I would add that never rebalancing. So having a portfolio and not rebalancing that from time to time, periods of growth, periods of contraction, whatever that might be. Not having a proper estate plan. That's self-explanatory. Or having an estate plan, but not following through on retitling all the assets. Claiming Social Security too early. A lot of people think they're not going to be around long enough, and they have cost them money in the long run. And then the biggest thing is just not planning for unexpected expenses or the unexpected itself. Premature death of one spouse or another, those kind of things. So how often should I assess my retirement plan? At least once a year, at least. But in life changes, death, divorce, after you buy, sell a house, major purchase, before a major purchase, always re-examine what your income needs are and what that may do for you. Is working longer or part-time beneficial? Absolutely. It can improve your Social Security and pension calculations. It can it lowers the amount of money that you're pulling out in retirement, and it also creates the opportunity to save more. Should I keep paying on my life insurance? As I mentioned before, it really depends on the policy type. In general, if you retire and you don't have any issues with paying bills or making ends meet, and you're retiring without any debt, then you really don't even really need it in most cases. However, life insurance can be maintained during retirement to help pay for estate taxes or help create just a little bit larger of an estate for those loved ones. If it's a permanent policy, do what I said before, request those in-force illustrations on those policies to kind of see how paying less or not paying it at all affects that. Will Social Security run out of money? Not in our lifetime, I don't think. Obviously, the trust is going to have some things done to it. But there will be enough people, especially for the people on this call, there'll be enough people paying into it to by and large paying way more of what's needed in that to get paid out as well. So, lastly, thank everybody. Thank you all very much. I've had a lot of people reach out. Your engagement is really what keeps us doing this. I hope you found some good information. I know not everything is fun, and I hope you found a lot of it applicable to you. Don't forget that everybody on the call has the ability at any time to reach out and schedule a one-on-one. I have a few people that have already done that. I would encourage you to do that. So let's talk about your individual situation. You know, a lot of this stuff is just general rules of thumb, but I can definitely be more specific on advice on your own particular set of circumstances. So reach out, schedule a call. Let's sit down. Let's do it. Whether you're 50 or 65 and getting ready to retire, schedule a call. Let's meet. Let's talk about your concerns. Let's troubleshoot on issues that you think you have and how we can make it better. Let's not run from it. Let's run toward it. And you know, identifying those things up front is the best thing we can do to, you know, to make it better in your particular situation. If that's something you're worried about, avoiding it only makes it worse in the long run. So listen, it's been a real steady amount of people on these lives, maybe more so than in some of the past years. There's always some we have more than others. That's just the nature of the beast when you do these. But I've seen a lot of the names being very consistent on here, and that's really great. And I really appreciate your all's attention, and really, appreciate your all's employers for giving us the opportunity to serve you guys. And I look forward to meeting you all and talking more further about your situation in one-on-ones. And I hope you utilize and take part of that process. But doesn't look like there's any more questions. So I'm going to let you all go today. Really appreciate it. You all have a wonderful day. Talk to you soon.